Welcome back to another episode of Financial History. Today, what we'll be looking at in our lesson is banking. Banking is a really, really old piece of financial technology. And a lot of times when people first learn about banking in an economics course, they often hear stories about British goldsmiths, bankers, 400 years ago taking deposits and making loans with them. But in fact, the concept of borrowing to lend is actually thousands of years old. It's a very easy outgrowth from the basic technology of lending. In fact, what really separates banking from lending is the idea of borrowing money from someone, specifically with the intention to lend it back out to someone else. Now, you might wonder why we would tolerate or seek out bankers in society when they simply seem to be intermediaries or middlemen that are otherwise getting between the ultimate source of capital and the ultimate user of that capital. But here's where a banker can really add value. If the lender doesn't have a superior ability to allocate risk, doesn't have the ability to necessarily evaluate the quality of a borrower, then it might make sense for them to simply hire someone who had specific professional skills in evaluating these kinds of risks. And if we had enough savers, then we might all want to band together to hire the same manager to make loans with our money. And then we would have a bank. So, I want to start off with in this first part of our lesson is talking about what the risks are of being a banker. Because at its core, there were three sorts of things that can go wrong in an operation where we borrow to lend. The first of these is what we call a liquidity risk. With a liquidity risk, we're talking about lending out most of our money and then having someone who has financed us ask for all of their money back, which of course is a classic problem that shows up in films like It's a Wonderful Life, where there is a run on a small community bank with everyone demanding their loans back at the same time. And it has to be explained to them by the banker that your money is safe. It's tied up in this person's business. It's tied up in this person's mortgage. So unless you want me to foreclose on all of our community businesses and all of our mortgages, we simply can't cash you out of everything right now. But as long as you maintain some faith, we'll be able to get your money back over time as people pay their mortgages and pay off their loans. But needless to say, this kind of problem, if it's not resolved properly, can destroy an otherwise solvent institution. So managing liquidity risk is a very important thing for bankers to be mindful of. The next is thinking about the risks associated with the costs of financing versus the costs paid by the people who are borrowing from the banker. In general, an easy way to think about this is to consider a banker who finances a 5-year term loan using demand deposits. So what I mean by a demand deposit is a short-term call loan, the kind of money situation where you can demand your money back immediately. So when you, for example, deposit your money into your checking account or your savings account, what you'll obviously expect is that you can get your money back from the banker at any time. In fact, we expect to be able to deposit $10 at an ATM and then immediately be able to withdraw that same $10. So this is a demand deposit. And usually demand deposits don't carry very high interest rates, but nonetheless, we do have to recognize that a demand deposit can be asked for back at any point in time. So how does a bank that borrows on this sort of basis safely lend for longer terms, like say student loans or auto loans, let alone mortgages? In general, the big risk is not just liquidity of people demanding their money back, but also a change in the financing rates. If, for instance, we had borrowed some money, let's imagine at 3%, and lent it back out at 5%. Now, our 5-year loan was on a fixed term where the interest rate won't change for the next 5 years. It stays at 5%. We're paying a 3% rate on our deposits because that's the competitive price in the market. What if conditions in the market change, though, and now other competitors are offering higher rates, or there are other alternatives where people could, say, shift their deposits away from us? In order to prevent a liquidity problem from emerging and having every money back, we might be forced to raise the interest rate that we pay on our own deposits. And that might mean suddenly paying 4%, 5%, maybe even 6% on our demand deposits, while the loan we've made with that money is still bringing in only a fixed 5%. So the possibility of a financing risk or interest rate risk is very real for someone who extends longer term loans and finances them with shorter term loans. This kind of maturity transformation, as economists call it, presents a unique risk to banks, which is very different from any other kind of lender who might simply be lending out their own assets and therefore unconcerned with the relative financing costs. Now, the ways that banks can deal with this and the way they've dealt with it historically is to try to fund longer term loans with longer term deposits. Products like certificates of deposit or GICs are exactly what banks are looking for as financing tools for their 2 and 3 year term loans. When you buy a GIC that doesn't allow you to cash out for 3 years and has a fixed interest rate, the bank has no fear whatsoever of its interest rate spread decreasing or of you demanding your money back within that 3 year period. And so it can effectively reduce both risks to some extent by trying to engage in what's called duration matching, or trying to at least match the maturity of different assets and liabilities. Another technique that banks have begun to use much more recently in the last my lifetime, let's say, is to offer variable rate loans that are financed, of course, with variable rate deposits. Since demand deposits have effectively a variable rate to them because they're so easy to withdraw and shift to competing institutions, we can sometimes get rid of that interest rate risk by simply passing on that variability to the bank's borrowers. We see this sort of thing happening when people have, for example, lines of credit at rates like prime plus one. As the prime rate rises or as the prime rate falls, their cost of financing changes just like the bank's does. And this reduces the bank's interest rate or financing exposure. Finally, and perhaps easier to intuit for most people, is default risk. The possibility that a bank will borrow, say, $100 from me, lend it $90 or out to a business, and then the business defaults on it. In those types of situations, we have a real problem because the bank still has a legal liability to me having accepted my loan to it. And therefore, banks usually have to retain what we call a capital buffer or an equity layer, which absorbs some of these losses when they do occur. The idea is that the owners of the bank will be the ones who feel the financial pain first, as opposed to the depositors. Now, of course, setting the right amount of a capital buffer or setting the right amount of loss absorbing capital is a rather complicated endeavor. There has been an attempt in the last few decades to quantify this and to get as many banks internationally on the same page using these risk metrics as possible in the form of the Basel Capital Accords that have come down from the Bank for International Settlements and the various central banks who ascribe to this and participate in BIS governance. The Basel Capital Accords effectively tries to estimate exactly how risky a portfolio of loans is. And the riskier a portfolio of loans made by a bank, the larger the capital buffer it's required to hold. So a bank that borrowed money from the public and lent it all to a government, for instance, would have to hold a smaller capital buffer than one that, for instance, borrowed money from depositors and lent it out to junior mining companies. To further protect depositors, though, we've also created in the last few hundred years what we call deposit insurance. The first kind of deposit insurance that we observe appears in 1624 at an Italian bank, the Monte dei Paschi di Siena. It is currently the world's oldest surviving bank, currently in talks to get merged with Bank of America due to some serious problems that they had over the last few years. But the idea at Monte dei Paschi in 1624 was to try to provide security to depositors that they would in fact get their money back, despite the fact that money was being lent out. And the way they did this was that the Duke set aside some particular piece of land just outside of the town of Siena, and the fees that were charged to herdsmen who wanted to bring their cows and goats to graze the field were set aside to guarantee the deposits of the bank. In this way, wealthier patricians of the bank were willing to provide Monte dei Paschi with capital that it used to make humanistic loans to the poorer members of their society. You'll also recognize deposit insurance from little stickers and posters every time you go into the bank, your bank branch, where you'll see that that your deposits are protected by the Canadian Deposit Insurance Corporation, or the CDIC. In CDIC protected accounts, depositors have insurance on up to $100,000 worth of deposits meaning that if the bank fails and doesn't have enough money to pay out all of the depositors from its own assets and its own equity, then the CDIC will in fact insure those assets up to $100,000 per account. Now, of course, this money ultimately comes from us as the depositors. Yes, the premiums are paid by the member institutions, but the member institutions simply charge us higher interest rates to pass on the cost of deposit insurance. So effectively, we are to some extent self-insuring, but doing so at a national scale along with everyone who makes a deposit in any of our banks.